Hello, everyone, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia, and today I want to slow things down a little and really walk you through something that, in my view, separates reactive traders from prepared ones. We are talking about macro, specifically, the top macro indicators to track in 2026, and why understanding what I'd call the best macro indicators for 2026 can completely change how you see markets, volatility, and opportunity. Now, I know macro can feel overwhelming. For a lot of people, it sounds abstract or academic, like something meant for economists rather than traders. But here's the reality. Whether you're trading stocks, forex, crypto, commodities, or bonds, macro is already driving your market. The only question is whether you understand it or whether you're reacting to it after the fact. In 2026, macro matters more than it has in years. Markets are deeply influenced by policy decisions, inflation dynamics, labor conditions, and global capital flows. We are no longer in a world where price action alone tells the full story. Context matters, and macro provides that context. Let's start with inflation, because inflation is still the center of gravity for global markets. Even when it's not dominating headlines, it's shaping everything underneath. Central banks, bond markets, equity valuations, currencies, they all respond to inflation trends. Most people think of inflation in terms of CPI, the Consumer Price Index, and yes, CPI still matters. PCE, or personal consumption expenditures, matters too, especially because central banks often prefer it. But in 2026, what traders really need to focus on isn't just the headline number. It's the underlying trend. Markets care about whether inflation is sticky or easing, whether price pressures are broad-based or concentrated in specific sectors, and whether inflation expectations are anchored or starting to drift. That's why alternative measures like core inflation, trimmed mean inflation, and median inflation have become so important. Inflation expectations are another piece of the puzzle that traders often overlook. When expectations rise, even modestly, markets start pricing in tighter financial conditions. When expectations fall, risk assets tend to breathe a little easier. This is why inflation remains one of the best macro indicators for 2026. It directly influences the cost of money, and the cost of money influences everything. From there, we move into the labor market, which is one of the clearest reflections of real economic strength or weakness. Employment data has always mattered, but in 2026, it requires more nuance than ever. Yes, the unemployment rate still moves markets. Yes, non-farm payrolls still cause volatility. But traders now pay close attention to wage growth, participation rates, and job openings. Wage growth, in particular, sits right at the intersection of labor and inflation. Strong wage growth can fuel price pressures. Weakening wage growth can signal cooling demand. Participation rates tell us whether people are entering or leaving the workforce, and job openings data helps us understand how confident both employers and employees really are. When workers feel secure, they quit more. When uncertainty rises, quits fall. That behavioral shift often appears before recessions show up in GDP data. In 2026, automation, artificial intelligence, remote work, and demographic changes mean labor data has to be interpreted carefully. But it remains one of the most important macro indicators to watch. Another indicator that consistently earns its place among the best macro indicators for 2026 is the Purchasing Managers' Index, or PMI. PMIs are powerful because they are forward-looking. They capture business sentiment before hard data like GDP or earnings reports. Manufacturing PMIs, services PMIs, and composite PMIs all tell us whether businesses are expanding or contracting, whether new orders are coming in, whether hiring is increasing, and whether supply chains are under stress. A reading above 50 signals expansion, below 50 signals contraction, but the real insight comes from the direction of change. In 2026, with supply chains still adjusting to geopolitical shifts and regionalization, PMIs often flag turning points before they become obvious elsewhere. That's why so many institutional traders treat them as early warning signals. Then there's central bank policy, which is impossible to ignore in modern markets. Even when interest rates aren't changing, central banks are constantly communicating. Their tone, their forward guidance, their balance sheet decisions, all of it matters. Markets don't wait for policy changes. They price expectations. That's why press conferences, meeting minutes, and even subtle language shifts can move markets dramatically. In 2026, central banks are trying to balance inflation control with economic stability, and that tension shows up in their communication. Understanding how central banks think helps traders understand why markets react the way they do, even when the data itself doesn't look dramatic. Bond markets give us another crucial set of signals, especially through yield curves and credit spreads. The yield curve, particularly the spread between short-term and long-term government bonds, has a long history as a recession indicator. When the curve inverts, it suggests stress ahead. When it steepens, it can signal recovery or renewed inflation concerns. Credit spreads tell us how much risk investors are willing to take. When spreads are tight, confidence is high. When they widen, financial conditions are tightening. In 2026, watching credit markets is essential because credit availability can slow growth even when other indicators still look stable. Consumer behavior is another area that deserves close attention. Consumer spending drives a huge portion of economic activity, and shifts in confidence often show up here first. Indicators like consumer confidence surveys, retail sales, personal spending, savings rates, and even credit card delinquency trends give us insight into how stretched or secure households really are. In an environment of higher interest rates and elevated living costs, these indicators are especially revealing. Housing is often underestimated as a macro signal, but it plays a massive role. Housing responds quickly to interest rate changes and influences employment, consumer confidence, and household wealth. Housing starts, building permits, home sales, and mortgage rates all offer valuable clues. In 2026, affordability pressures and regional differences make housing data even more important to interpret carefully. Zooming out globally, trade and supply chain indicators continue to matter. Export and import volumes, trade balances, and shipping rates reveal shifts in global demand. These indicators often flag slowdowns or recoveries in specific regions before domestic data does. Commodities also function as macro signals. Energy prices, industrial metals, and agricultural commodities reflect both supply constraints and demand strength. Sharp moves in commodities often feed directly into inflation data and corporate margins. Finally, composite and leading economic indexes help bring everything together. By combining multiple data points, they smooth out noise and provide a clearer view of the broader economic direction. They are not perfect, but they help confirm whether individual signals are part of a larger trend. Now, understanding macro is one thing. Tracking it effectively is another. If you're serious about following macro indicators alongside price action and technical analysis, you need tools that make this information accessible and actionable. That's why I recommend taking a look at the world-class, cutting-edge, user-friendly trading platform app from Crystal Ball Markets. You can find it at crystalballmarkets.com/platform. It's designed for traders who want clarity, speed, and the ability to integrate macro data directly into their analysis. And if you're still learning, or you want macro explained in plain language without jargon, the Crystal Ball Markets podcast is a great resource. It covers trading, investing, macro, and financial markets in a way that's approachable and practical. You can listen at rss.com/podcast/crystalballmarkets. So here's the big picture takeaway. In 2026, markets reward preparation. Tracking the best macro indicators for 2026 gives you context. It helps you understand not just what markets are doing, but why they are doing it. Inflation, labor data, PMIs, central bank signals, credit conditions, consumer behavior, housing, trade, and commodities all tell parts of the same story. When you learn to read that story as a whole, your decision-making becomes more disciplined and less emotional. Macro won't make you right every time, but it will help you avoid being blindsided. And in today's markets, that edge matters. Thanks for listening to Financial Market Insights for Traders. I'm Sophia, and I'll see you in the next episode.